Hello, everyone, and welcome to the Glio CEO Investor Series. I'm Chris D'Annunzio, a portfolio manager at Cohen & Steers, and today I'm joined by Justin Brown, the president and CEO of Southwest Gas Holdings. Southwest Gas is one of the largest pure-play regulated natural gas utilities in the United States, serving roughly 2.3 million customers across Arizona, Nevada, and California. Before we start, I'd like to thank Glio for facilitating this conversation and for all that they do to support infrastructure investing globally. With that, Justin, thanks for being here.
Yeah, thanks for having me, Chris. Looking forward to it.
So to start, Southwest Gas today is a very different company from what it looked like 10 years ago or so when I first started following you all. You've sold non-regulated assets, you've improved your balance sheet, you've increased your growth rate pretty materially. Can you just walk us through some of that history and the investment thesis for Southwest Gas from here?
Yeah, you're right, Chris. It's pretty amazing when you think about the journey we've been on and how different the company looks fundamentally, just compared to 3 or 4 years ago. Now we're a pure play regulated natural gas company. We have a fortress balance sheet and we have a strong growth story supported by improving regulatory jurisdictions across our 3 states. Our investment thesis really starts with the base business, which is essentially essential energy infrastructure serving about 2.3 million customers across Arizona, Nevada, and California, improving regulatory jurisdictions, and a strong commitment of working collaboratively with our regulators in all 3 states. And I think that commitment and regulatory partnership is really what helps support our capital plans, rate-based growth, and constructive regulatory mechanisms. Our team works extremely hard to manage O&M costs. We try to find efficiencies, optimization opportunities within the business to help keep service affordable for our customers. And I think on top of already what I think is a pretty compelling growth story at the base business, we have a very unique opportunity with our FERC regulated asset, Great Basin. Great Basin's well positioned to serve an area of northern Nevada that appears to be one of the fastest growing energy demand markets in the country, with data center demand, power gen, mining, manufacturing, and broader economic development in that region. We think Great Basin's an expansion opportunity that meaningfully accelerates our earnings growth and cash flow for years to come.
That's great. And Justin, what about you? You've been in the CEO role for a few months now. Obviously, you've been with the company for over 20 years, much of it on the regulatory side of things. But for investors a little bit less familiar with you, can you talk about your background? How does that regulatory experience shape how you're going to lead Southwest Gas going forward?
Yeah, I appreciate it. It's a good question, Chris. I think when I think about the utility sector, success in this industry really comes down to balancing a lot of different interests, whether it's customers, regulators, employees, communities that we serve, or stockholders. And as you mentioned, I spent a good portion of my career on the regulatory side. I started out in our legal department, actually supporting regulatory from that purview, and then later transitioned into a leadership role within the regulatory team. And I think that experience really taught me about the importance of relationships and how important our regulatory relationships are, and the importance of working together with all stakeholders. When we work together as partners, we get outcomes that genuinely work for the benefit of customers and all stakeholders. And as CEO, we've got a clear strategy and a strong team. And my focus is really making sure that we deliver consistently, invest responsibly, and keep creating value for the people we serve and the investors who support us. And we're really focused on, in that regard, we're really focused on just effective communication and alignment across our team. And I think that's going to really translate to supporting a real disciplined approach to execution of our strategy.
That's great. Okay. I definitely want to come back to the regulatory side of things. But before we do that, let's maybe talk about the capital plan and the growth rate. So I know the 6.3 billion of capital is driving this 12 to 14% EPS growth through the end of the decade, which frankly, that's a lot for a regulated company. And so can you go into a little bit more detail on what exactly is happening in your service territory, Great Basin and the like, that is underpinning that type of growth?
Yeah, I think it really comes down to two things happening at once. And it really starts with our core utility business, which is the foundation. We currently have about a $4.6 billion of planned investment over 5 years. And it's really to keep up with customer growth and really modernizing our distribution system, making sure that it's safe and reliable for our customers. I think the other thing is we're currently in the middle of refreshing rates across all three jurisdictions. We're also working with our regulators in Arizona and Nevada to support mechanisms to support the more timely recovery of prudent investments through the use of either formula rates or some other alternative rate making model. And I think the second thing, so that's really kind of the first item. I think the second thing that I mentioned is really gets back to the Great Basin Expansion Project. When we think about demand from data centers, power generation, mining, manufacturing across northern Nevada, and in particular in an area that's southeast of Reno, referred to as the Tahoe Regional Industrial Center, we really see a lot of demand in that area, and it's been so strong that we've ended up bumping up the project from a 42-inch design to a 48-inch design, and now we currently estimate about a $2.3 billion capital investment, up from the previously disclosed and what's built into our plan, which was 1.7 billion. And that's really backed with about 1 BCF of a day contracted capacity that's backed by surety from those shippers. And so when you put those two together, I think that's where you really get the story and the growth story that supports that 12 to 14% growth profile that you mentioned. And, being a pure play natural gas company with predictable, regulated, supported growth, plus a large scale pipeline opportunity, I think that's what really differentiates us from other regulated companies.
Yeah, that's great. And as we think about Great Basin, can you touch on things like permitting, supply chain, labor, and just broad sort of construction milestones that investors should look out for?
Yeah, absolutely. I think Great Basin's pretty unique project in the sense that it's a brownfield project. It's a cost of service regulated, FERC regulated project. And the shippers that we have, it has shippers today, utility, high credit worthy shippers. And we're simply upsizing that main line to accommodate the new demand that we're seeing. And those new shippers have signed binding precedent agreements. They've also posted surety to help cover their proportional share of the cost of the project. And that's really done to make sure that we're protecting existing shippers, but other shippers from any kind of potential default. And right now, when we think about the contracts that we have in place, as I mentioned, we have about 1 BCF a day tied to the 2028 expansion, which is why we've upsized the project from 42 to 48. Part of that was done, our supply chain team does a great job of getting out in front of things. So early on, we identified and worked very closely with those supply chain contacts to make sure that, we have flexibility, for instance, of moving to 42 to 48. And once we got comfortable that was not going to be an issue, we made that decision. I think once the project's in service, as I mentioned, we have about a 200 or a $2.3 billion estimate now. As a result, when we think about kind of the margin, the annual margin that comes from that, we're expecting between 270 to $300 million of margin, which is going to provide a significant source of durable and predictable cash flow for us into the future. Right now, we're currently on track for a 2028 in-service date. We received FERC pre-filing approval earlier this year, and we're currently moving through that engineering, environmental review, public outreach. We've held different open houses, and we're in the stages of working on the permitting process now. But we're on track to make our official FERC filing later this year with an estimated approval in late of 2027. And then from there, we anticipate about a 12-month construction cycle, and we're targeted an in-service date in the fourth quarter of 28.
Yeah. Okay. And maybe can you touch on the balance sheet a little bit more? It's starting from a position of strength, but I know you guys don't see the need for much external equity. You have quite a bit of cushion relative to your downgrade threshold. Is that going to hold through the planning period? And how do you make sure you kind of get credit for that balance sheet from equity investors?
Yeah, that's something that we're definitely focused on, and we do feel comfortable with where we're at. Our approach to kind of managing that balance sheet is pretty simple. It's, we're focused on protecting our investment grade rating, funding the growth plan efficiently, including minimizing any kind of equity dilution for our stockholders. I think this gets back to kind of the first question of our transformation. I think the Century sell down really gave us a lot of flexibility here. We don't expect to issue equity in 26 outside of our dividend reinvestment plan. And even with the equity needed for Great Basin and kind of the upsizing of Great Basin, we still view it as being a pretty modest amount over the planning horizon. And so that's kind of really where we're at from a balance sheet perspective.
Yeah, that's great. Okay. Maybe turning back to the regulatory side of things, and you alluded to Arizona and Nevada going through, formulaic rate making or rate adjuster mechanisms. The company has historically under-earned its authorized return. And so as you shift to more real-time recovery, is that an opportunity to materially reduce that regulatory lag and support earnings power? And what should we kind of look out for to ensure that any changes to the compact are durable?
Yeah. Now, I think to your point, I mean, improving our earned returns is a top priority. We're currently sitting at about an 8% ROE, trailing 12 against an authorized, which is closer to 9.8. So there's a real opportunity to continue to close that gap. But as I mentioned earlier, we have 3 rate cases pending, or we're in the middle of refreshing rates in all our jurisdictions. And so we have outstanding revenue proposals, over $200 million worth of revenue increases that are outstanding. And so I'm actually really proud of how well we're optimizing the business and how effective we've been at managing O&M costs and minimizing that difference between our authorized and our earned ROEs compared to the past. So I feel like the potential of where we're going in terms of these enhancements are going to be very meaningful for investors. When I think about kind of different experiences that I've had with kind of the regulatory involvement, I found that a lot of the best outcomes are really not from the utility pushing what they want, but really sitting down with our regulators and key stakeholders and building something that works for customers and investors together. The reality is I think both stakeholders actually have a lot more in common than they don't. And so we just need to work together to find those outcomes. And that's really the spirit behind what you referenced with kind of the changes in the regulatory construct. When we think about Arizona and Nevada, Arizona, we have a formula rate proposal that's pending. In Nevada, we passed legislation that supports alternative rate making. It's currently working its way through the rulemaking process now. But I think both were really shaped with that kind of back and forth collaborative approach with regulators and policymakers. So I think if those mechanisms land the way we expect them to, we anticipate that we'll be able to close that regulatory lag by probably close to 100 basis points over time. That's really what our focus is, which will be a real meaningful improvement for our returns, or our earned returns, I should say. But I think both approaches are designed to help better align infrastructure investment with cost recovery, provide greater predictability for customers and investors alike. So we're pretty excited about both those opportunities.
Yeah, that's good to hear. And what about just affordability broadly has been very topical across a lot of states. Do you think that's more on the electric side than the gas side? And how do you balance all this capital you need to support growth with maintaining competitive rates for customers?
Yeah, I think to your point, it is somewhat probably more focused on electric, and it's also geographic in nature, I think. But I think having said that, affordability isn't really a new issue for us. I mean, it's something that's always been central to our mission. I think when we think about natural gas, I think it has a great, long, successful track record. And I think personally, I think it's probably the most effective tool for balancing the competing interests of improving quality of life, energy reliability, energy affordability, and driving down economy-wide emissions. So I'm very bullish on natural gas, and I think what it does for our economies and for the communities that we live and work. And then also when you think about the efficiency of natural gas and the fact that it's over 92% efficient from wellhead to appliance, arguably one of the most efficient uses of energy for customers, and is also one of the most cost-effective and dependable options out there for heating, water heating, cooking, a lot of commercial and industrial use. One of the best things I think we can do just as policymakers and working in the states that we serve is just helping ensure, a strong electric grid by continuing to introduce energy diversity with dual fuel homes and businesses. And as I think when we think about investment in our system and customer affordability, we're not just chasing growth, we're picking projects, we're working with regulators to improve safety and reliability. But we're also very sensitive to being competitive value proposition for the customers that we do serve.
Right, right. What about, because there's sort of the absolute bill level, and there's also the volatility of bills around things like gas costs. I think back to Winter Storm Uri and other major weather events. What can you do to kind of protect customers just from unforeseen spikes in the commodity, which is a pass through for you guys, and how do you approach that?
Yeah, our the responsibility and the process we follow to procure natural gas on behalf of our customers is something we take very seriously. And like you said, it's harder to kind of manage those macro economic items, but we want to make sure that the gas we're procuring is the best available option for our customers, both in terms of price, but also kind of the reliability or the certainty that it's actually going to get there when we call on it. And so we're very committed to working with our regulators to making sure we have effective mechanisms in place to help manage volatility for our customers, making sure that our bills remain competitive and our customers feel like it's a strong value proposition. And to your point, while we can't directly control those again gas costs, if you will, we do have the ability to work with our regulators to make sure that we have things in place to minimize those impacts. Some of those things would include just the process that we have in terms of our purchase gas cost adjustments, working with regulators to make sure that we have the ability to recover those costs, that we can minimize the carrying costs associated with them, but that we can also recover those. Again, I think those all help the long-term cost for the customer. So we're very focused on maintaining a strong balance sheet, maintaining plenty of liquidity to bridge any kind of timing gaps between when you have those gas spikes, like you mentioned, around like a winter storm Uri, and that we can recover those by maintaining a strong relationship with our regulators. So I think it's really that combination that kind of keeps cash flow stable, protects our customers from unnecessary financing costs, and minimizes volatility when we do see those gas price spikes.
Okay. And you talked about data centers a little bit. I know that's a part of the demand story, not all of it for you guys, but I'm curious, what are you hearing kind of from your customers around their gas needs, their power needs? How durable do you think that demand growth is, and what is it about your service territories that seems to be attracting some of these large customers?
Yeah, I think data center demand on the gas side is real. I think it is more durable than people might assume. I think when you're talking about firm dispatchable power for these facilities, natural gas is often the most reliable path, especially in regions where the electric grid might be constrained or it needs time to catch up with demand that we're seeing across the country. I think really the Great Basin project that we've talked about is really kind of a strong case study for that. When you think about the contracted volumes that we have, and then I think one of the things I didn't mention earlier is, in addition to the 28 expansion, we have expressions of interest from 29 to 2020, 35, where there's just a lot of demand. I think it's about 1.8 BCF of demand that's been expressed that we're currently working on to figure out what those future expansions might look like. And so I think those are all, I think, very much strong data points suggesting, kind of the growth around data center, the demand for energy in this region. I think when we think about our customers and our stockholders, we're really focused on making sure that we're keeping the risk on the right side of the ledger. And that is like when we think about Great Basin and the fact that it's a cost of service regulated project by FERC. The other thing that we're doing is we're making sure that, the contracts that we're entering into with the shippers, that they're long-term contracts, they're requiring surety of those shippers to make sure that we're protecting existing and new shippers from any kind of future defaults. And so we're trying to be very thoughtful about, not building ahead of demand and asking customers, captive customers to backstop that risk. It's things that we're trying to do through our contracting process and how we're being thoughtful. And I think really it's that discipline that's going to let us lean into these opportunities without compromising the core utility business model.
Yeah. We often talk about data centers and AI from the standpoint of infrastructure needs, capex, what it means from the business on that side. But what about internally? I'm curious, how is Southwest Gas utilizing AI? Do you see that as helping with some of your O&M efforts operationally? Does it help at all? Is it a little early to have that conversation? Just how are you thinking about that?
Yeah, I think it's definitely in the early innings, Chris. But I think it's a real opportunity. I know we're looking at AI and advanced analytics across the business, and I think like most companies, we want to improve efficiency. We want to give employees better tools, better information. Making things more accessible in a more timely manner that allows people to actually kind of stop and do a deeper dive analytically. And so I think operationally, I think one of the clearest opportunities you mentioned are kind of around, kind of predictive maintenance and replacement, leak detection analytics, workforce planning. I think there's some customer and employee self-service options that, might be out there. But I think it really starts with we need to make sure that our data is clean, that we have a single source of truth so that, we feel good about that. And so those are things that we're working on to kind of build a foundation for the future. And then I think when we think about just the infrastructure, it's really about because of the nature of our business and the fact that we provide kind of a critical necessary infrastructure. We want to be very cautious, if you will. We just want to be very thoughtful, careful with how we go about it. Ensuring safety, reliability, cybersecurity are all front of mind for us. So that's why I say I think it's early, and I think it's going to be kind of probably maybe a little bit of a slower journey compared to other industries, but I do think there's a lot of potential.
Yeah. Okay. Well, look, Justin, thanks for a great conversation. I'd like to again thank Leo for facilitating this. I'll turn it back over to you. Anything we missed? Any closing remarks that you'd like to leave us with?
No, it's great seeing you, Chris, and appreciate the exchange. I think if may I just mention that if people want to learn more about Southwest Gas Holdings, our website is swgasholdings.com. And if I may, I would just kind of summarize, I think, our story, if you will, at Southwest Gas, which is I think it's built on a pretty simple foundation. We're a pure play, fully regulated natural gas business. And I think everything starts with running that business safely and reliably for the benefit of our customers. I think that discipline and our commitment to our customers, our employees, and our regulators really earns us the constructive relationships that we have with our regulators. And that's what translates to some of the strongest growth in our sector, a 12 to 14% adjusted EPS growth rate that you mentioned earlier through 2030. And I think it's really supported by steady, consistent rate base expansion opportunities. We built an exceptional balance sheet. A lot of it was through that transformational activity that you mentioned at the beginning. And that really gives us the flexibility we have today to fund the growth without leaning on our stockholders. We're committed to a sustainable dividend and also delivering strong and predictable returns for our stockholders. So I think it's a long-term growth story. Our job is really about execution, making sure that we keep executing quarter after quarter. And really appreciate the time today, Chris, and thanks for the great questions and the opportunity to be here with you. I'd also like to thank Glio for inviting Southwest Gas to take part in today's event and for their continued promotion of investment in infrastructure asset class. So thank you for the opportunity to share more about Southwest Gas today.
Absolutely. Well, thanks, Justin, and thanks everyone for tuning into the Glio CEO Investor Series.